Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, we have a National Day of Mourning today for Jimmy Carter. I am getting futures market data and everything, so but I'm not expecting a whole lot to happen. And I created the stream a little bit late here, so I don't know we can get a whole lot of people. I think that we are likely to maybe do some programming stuff. Maybe just look at Rust. We'll see. Let's just come over to the charts, though, and kind of review what happened yesterday. Well, we took a trade on the long, and it did eventually turn out in our favor. And it looks like after settling for quite some time and a little bit of wrangling back and forth, we closed pretty close to the highs. S&P 500, meanwhile, very, very range-bound yesterday. Oil, giving up a lot of those gains. Really just a lot of volatility in oil. Gold and silver extending here this morning, though. And copper almost breaking out over here. Oh, it did, in fact, pretty conclusively. What's going on in copper? What's going on indeed? Japanese yen. Okay, Japanese yen looking a little bit better today, but the dollar's still really strong. And the bitter coins still a little bitter, coming back below 100,000. One thing I would note, I almost forgot, but we had that bit of volatility. We got FOMC meeting minutes, and the minutes basically said that FOMC members are concerned about possible resurgence in inflation. And it kind of seems to me that it's pretty much entirely based on policy uncertainty. I honestly, I kind of think that it's bullshit. Like, because you don't know what the policies are going to be exactly. But why is it that we are kind of warning and getting ahead of inflation from Donald Trump when it's a really complicated situation that we don't really know what's going to happen? But then when we had a situation that was pretty simple, the government was printing a lot of money, and they gave Biden the benefit of the doubt, right? If the Federal Reserve's concern about a resurgence in inflation is justified now, then that means that they gave Joe Biden benefit of the doubt when they shouldn't have. And I think there's like not really any way around it anymore. Like I kind of think that that's the way the history is going to look at it. Of course, that all kind of depends on whether or not a resurgence in inflation actually happens, doesn't it? Because if it doesn't happen, then they look double dumb. So, but you have to mention that. I'll read around a little bit. I am buying building supplies companies. I might hoard wires. But why is that? Is that why we need to just buy copper? Just buy Freeport McMoran? Maybe, But Mourning, what's your tick target in 1 day at dawn? I don't approach it that way. So what you will find if you go and you do backtesting, for instance, that if you have a set stop and a target, regardless of whether that set stop and target is based on just a set number, or maybe it's adjusted based on projected volatility, your results end up being mostly a function of that stop and target. So if you want to get results that are much more likely to take advantage of the fat-tailed nature of markets and get you interesting statistical properties of it, you cannot use a set stop and target. I think that if you have something that's like, this is a good short-term signal, for instance, like this happens, we're really likely to move up, yada, yada, yada. At least when you're backtesting, the best way to kind of show that is to use a time exit. So, and I kind of rely on that a little bit more. Like if it's been 40 minutes and I'm still down, then I'll give up on it. I don't use a target because the market doesn't care how much you want to make in a day, right? No equities today, says Uzi. Yep. Have you seen LA? It's all up in flames. And so that's why you would want to hoard wire? Okay, so I'm a little bit skeptical that despite the amount of damage, I mean, it is a significant amount of damage over there in LA. Don't get me wrong. But I don't know if that would actually be a real significant would that be something that we would really see a noticeable impact in the demand for certain goods as they rebuild it? I suppose it's a possibility that I shouldn't ignore, huh? And it does really seem to me like that copper has kind of been taken off this week for like no real good reason. What time do the US futures? Well, so I'm not sure today. Do we have a early close or anything like that? I'm not sure. I honestly haven't looked at that. Taking into consideration the one-party bureaucracy there, it will take decades to rebuild that stuff. Oh, who knows? I don't know if I'm just in like ultimate skeptic mode today, but I really don't have enough information to really know how much the bureaucracy would hamper rebuild efforts there. Part of it would be how bad is the damage actually, and is definitely, you know, like in my mind, this is a really big win for Donald Trump because he has been harping on this issue forever. I can't tell you how many times there's been a thing about this. Like, do you remember when he complained about, you know, them cleaning the underbrush and complaining just about how they manage the forests in general, and how California mismanages their wildlife. And like the media was throwing a huge fit about it. Like there's been multiple episodes of this, and then he was 100% right. He was 100% right on this one, man. If Trump helps California, all that money will get embezzled by NGOs. Well, I don't know. I mean, the thing is you're going to have pretty influential, smart people that are paying attention, and you know, it's kind of funny. Like one of the things that I've seen is all these people that were always saying that, like, well, you know, like theft is sometimes justified, and you know, is protecting your property really worth killing people, and all of this and that. And now they're all super, super upset when their homes are getting ransacked. But again, I guess I have to take a step back here. Because the thing is, okay, so like, there's definitely some damage going on there. There is definitely a political angle to it, because California, on many, many different levels, mismanaged this. And Donald Trump saw it coming for years and complained about it, and nobody did anything. But there's also something that, because of all of the political implications, the media is going to hyper focus on it and is going to draw your attention to it when it's not necessarily the place where your attention needs to be. So I'm always, always, always skeptical when the media is super interested in a story like that, because often the most economically impactful things the mainstream media doesn't really give a crap about. So like, I have not seen any information about like the number of homes impacted and all of this sort of a thing to be able to compute like what the impact of it is. I haven't seen any reports about what the impact of it is. So until we see that, let's try to you know, be a little bit cautious of it, because I think that there's a lot of people. This is one of those situations where people will really drum up political opinions that don't end up being good investments, you know? Amir, good morning. Looks like everybody's here despite the National Day of Mourning. Okay, 5 dead and more than 2,000 structures burned as a new fire hits Hollywood Hills. I don't know, guys. So like, for something that like there's like 1.5 million of a year, when we're talking about like building new homes, I don't know if 2,000 is actually a significant thing. JJ says, I thought the market was closed today, isn't it? Well, it is, but this futures is different, right? Hold on a second. I'm gonna go check something. I think I forgot to put the trash out, and it's trash day today. we're good. That sound that I heard was them emptying my trash. So, hey, we did put it out. What's this? What I find interesting is how non-New York residents get so bent out of shape about how those states spend their state revenue. I mean, what are you talking about? The congestion tax or whatever? Everybody cares about how New York runs things because that's like the epicenter of the American left, and they're making all sorts of stupid mistakes. I'm just saying, we didn't have those problems when Giuliani was in charge. You know, I think the thing that's kind of funny, because there's a lot of talk about, like, oh, DEI. Like, I keep seeing a lot of posts showing the people that are in charge in California with these fires and saying, oh, these were incompetent people that were only hired because of DEI. Well, I do kind of, I highly doubt that you would get that combination of people without DEI, probably, but that doesn't necessarily mean that they're unqualified. But I think that the issue is that I really don't think that our society has very good mechanisms for determining who is qualified and not. I think that there's this idea that, like, you go through the interview process and you get selected for a job, and that means that you're the best person for the job. And I just think that that's absolute nonsense. I think that there's a large portion of jobs out there that people get just because of connections. I think that there's a large portion of jobs that the person that is selected, it's not necessarily because they have the greatest skills, but because of a number of other compounding factors, like that they just happen to know the right technologies. All of these sorts of things. This whole idea, whether it's within government or business, that if we just give the most qualified person all of the power, that everything will turn out okay, is a complete misunderstanding and misreading of what we've learned in modern society about things. But I think that what we've really learned is that for most situations, it's extremely likely that you're going to get somebody in there that doesn't know what they're doing. And so the best thing to do is to have systems that are extremely robust and aren't controlled by any one person. You know? The only situation where I really feel like that you want to give it all to one person is like a extremely risky venture or like an art, right? There's things where you don't want to design by committee, okay? But when it comes to power, it's in everybody's interest for power to be split up. We're seeing a couple of situations here where it kind of looks like that certain officials had too much power and those officials weren't very competent. And I'm not going to say that it's something just specific to New York and California, but they're sure not looking very good right now, are they? But I'm still really, really skeptical about investments based on the Palisades fire, unless those investments are going to be specifically in Palisades. Okay? Same stuff happens in national discussions whenever we get hit by hurricanes in Florida. Everybody wants to lecture us about climate change. Yeah, it's so true, dude. Like the last storm, everybody was telling me this is it for Florida. This is where they're finally gonna realize that they can't ignore it anymore, and everybody's gonna leave. And nothing happened. Our states are small. Yeah, I mean, the interesting thing about hurricanes is that they happen relatively regularly. So the state has gotten pretty good at it out of necessity, right? Both governor. What are you trying to say here? Both governors in New York and California are hard left, but people voted them in. Well, yeah, because it's it's California, New York. I really don't understand what your problem here is. It kind of sounds to me like what's happening is we're criticizing decisions that California and New York have made, and you don't like being criticized, so you're trying to make up some argument about whether it's our business or not. Who cares whether it's our business or not? I can criticize whoever I want to. I can talk about whatever issue that I want to, and if I see somebody in New York or California doing something stupid, I'm probably going to point at it and laugh. And it doesn't matter that I don't vote there or that the people there liked it or not. I can still talk about it and laugh at it. Like, oh, there you go. You think voting helps? Well. Yeah, if I had to fork over 30% of my income to the state and I didn't have a fire department, oh yeah. That is pretty crazy. But that's kind of more down to that particular city, isn't it? I don't know, like when I look at a lot of like California in particular, when I look at California's problems right now, it's really that they took really high risk, decisions on certain unproven policy ideas. I don't know what made them think that like making petty theft a non-crime was a good idea. But, like that's a pretty radical policy change that didn't work out for them, right? And they did too many of those. Yeah, that's a good point. Federal income taxes do anything other than service to national debt. State and local taxes in California and New York don't come to Florida or Alabama. Oh, they come to Utah. Dude, this is one of those. So now you're getting into a debate that is like really effing annoying to me. So like one of the things that they'll say is, okay, which states are net contributing to the federal income, and which states are like net draws on the federal income? Well, states that are more rural are more likely to have, you know, resources in them and things that the federal government is doing, and that's why those states get more federal funding. It's not because they're so poor and the government needs to spend money on them. It doesn't work like that. See, the tactic that I see that the politicians take advantage of in that debate is they will get so down into the weeds and gish gallop you that you really like can't make sense left from right, when really all you got to do is take a step back and look at the two numbers that matter, right? Federal expenditures as a percentage of GDP and federal income as a percentage of GDP. And when you look at that, both of those numbers have gone up. Like we are bringing in substantially more revenue than we did. We're spending substantially more than we did, so it doesn't help. That's how they, yeah, there you go, exactly. And the problem is that expenditures from government tends to be less productive by its very nature. Because if they were high growth, really productive things, the free market would be jumping over itself to do them themselves, right? The things that government does are the things that don't really contribute to growth, that there's not a profit in them. So the more money that is being expended, more of GDP that is coming from the government, the slower you grow. So that's what Alan Greenspan does these days. He puts out economic research on that subject. Need to get some more water. Hold on a second. Okay, so if the GOP was so fiscally responsible, how do you explain Trump in 4 years accounting for 25% of our debt? Well, because there was a pandemic, Nimrod. I'm sorry, I like start name calling there, but like that just kind of is like, what a dumb argument, man. You know what happened. We all know what happened. Why would you make that point? Knowing that like, did you not sit there and think, oh, well, if I say this, probably the first thing that he's going to point out is that there was a pandemic? Come on. Come on. You're smarter than that. During Donald Trump's first term, fiscal responsibility was definitely not a priority, was it? the whole thing is that you're like his whole play there was to juice the economy and then use that juice as leverage in a trade war. Fixing fixing government expenditures was not the top priority, right? You pointed out Biden's spending on the pandemic in the first year of his presidency. He would say, but there was a pandemic. Yeah, a pandemic that was already like mostly solved by that point. It comes back to the toilet analogy for me. When we're talking about inflation, and a lot of leftists are like, well, it was Donald Trump's fault. Okay, well, like if I go to the bathroom and I flush the toilet and then the toilet doesn't flush, and then you come along later and you see that the toilet is not flushed, but you decide to go in it as well, and you try to flush it, and when you try to flush it, the toilet overflows, who do you think is going to get blamed for the toilet overflowing? The last guy that pulled the lever. I mean, yeah, they both pulled the lever, but you pulled the lever when it was already overflowing. And that's why Joe Biden gets blamed for the inflation. Look at, okay, but you use the 25% amount, right? The amount that Donald Trump increased the expenditures prior to the pandemic is pretty much in line with his predecessor. Is this a trading channel? Well, trading is inherently political, Alfonso. Like, who knows more about the things that are going on in the economy, the things that the government are doing? Traders. You show me a trader that doesn't know anything about those things, I show you somebody that's probably not going to last very long. Oh, I came to you by the garbage price action video. Thank you. You know, I that one has been kind of frustrating me lately, just because was not really very convincing to the people that are really dedicated to price action. So I'm glad to see that it helped somebody. Oh, where is it? There you go. Government expenditures per GDP. Well, it increased after the financial crisis. Obama really stimulated the economy for a long time. Yeah, like, did Donald Trump do stuff? Sure, but it was mostly in line with what had been happening before. And then we had the pandemic. And then because we got inflation, they said, oh, that's a bad idea. They went back to what it was before. Teeny tiny, a little bit higher. I'm not saying that Donald Trump was like really focused on being fiscal, but come on. I know. I wanted to go back to the early argument, which was, like, why do you care what the way that California decides to spend their money? I'll tell you why. Because they ruin their state, and then all of those idiots try and move to my state and do the same stupid things in my state. And when we tell them, no, that's stupid, they throw fits. That's why I care. those of us in Nevada, New Mexico, Utah, maybe Idaho a little bit, like we know this one all too well. California trying to export its stupidity. Yes. You know what's the thing that I just don't like I know that when you're in a large city, okay, like things get more expensive from living in a large city. But things are a lot more expensive in a Democrat-run large city than in a Republican-run large city. Like I've never understood why people haven't figured this out, that like, yeah, Democrat policies in general tend to increase the prices of things. How is their state ruined? It's the most populous state with the largest economy. Okay, so what you're doing there is you're taking like the history, right? There's all sorts of reasons why California is like the most populous and like the generating the most GDP, okay? That have absolutely nothing to do with Democrat policies, right? For one thing, they're the major port on the West Coast. Okay, so you know that would be great if we had a outlet to the ocean in Utah, but we don't, right? And that's just where it was. Like the thing is that California had become the most populous state and had become one of the greatest generators of GDP long before they took this hard left turn, right? Okay. Similarly, when you go and you look at the deep South Republican states, okay, those are places that have been historically poor for a long time, long before like the Republican Party in its current iteration existed, right? Okay, Jaycom asks a good question. Why are you trading treasuries instead of futures such as ES and NQ? So, by and large, my argument is that the action in the S&P 500 is mostly random. I think that if you are trying to like take tiny little scalps and, you know, taking lots of trades and trying to like look at a chart, that ES and NQ are going to be like the most interesting to you. But the actual amount of alpha that you can pull out of that, I'm very skeptical that there's actually any alpha in it at all, to be honest with you. I think that there can be some situations where there's a certain major change in the market and the S&P 500 starts a trend in one direction or the other. The example that sticks out in my mind the strongest was when QE2 was announced way back in like 2010 or whatever, and like the market was actually selling off on it, and then that just started like the greatest bull run of all time. So there can be situations like that where you can see that and you can swing long in S&P 500. But like these, like which direction is the S&P 500 going to go in the next 5 to 30 minutes? That's just like an insanely difficult thing to find an edge in. And I think that most people there are trading ES, you know, because of the amount that it moves and not necessarily because they have alpha in it. Whereas in the treasuries, if you're going to, if you don't have an edge, and your edge is basically has to be being informed, knowing things about that instrument that other people don't, knowing things that are going on in the economy that affect that instrument that other people don't, and you know, understanding how that market works. I think that your best opportunity is in the treasuries. Because if you go to something like copper is something that I would be interested in trading. How do you find information about the copper market? How do you find this information out about which mines are opening and closing and trends in that industry and all of the inside information about copper? I'm sure that there are mailing lists and things like this about the copper market, but I don't know what they are, and it's probably super expensive if they exist, right? Whereas the information about the treasuries, because the treasuries affects literally everything, there's so much information about that you can come in and read every day and become an informed player in the treasury market. So that's why I trade the treasuries. If you don't want retirees, then maybe your state should stop passing legislation to make it attractive to seniors. That's probably true. But there are some big advantages to bringing those people in. But I'm not against having retirees. What I'm against is these people that moved because their state was a problem. California is a great place, should be a great place to retire to, right? But by and large, people are leaving California. It's not working for them anymore. And it's the same thing with New York, man. So many of these algorithmic trading and these sorts of guys is leaving New York in droves. Moving some of these finance guys are setting up shop in Miami, which is just absolutely crazy to me. Doing that in Miami, but that's what's happening, because living in New York is just getting harder and harder and harder. Now they've introduced this congestion tax. Most of the people that live in the city can't pay the congestion tax. They're going and looking just these first few days. The amount of traffic that it has reduced is absolutely crazy. So what happens? Everybody has to use the public transportation, which I suppose is what they kind of want. But why were people not riding the public transportation? People were like middle and upper middle income people in New York were avoiding the subway because they felt that it was unsafe. And that's by and large the thing, is that since Rudy Giuliani left, New York has gotten less and less safe, right? I'm tired of guessing. Are you straight? Yeah, I'm married and I have 5 kids. Well, 3 stepkids and 2 kids of my own. It's weird that you're thinking about that. I know. Maybe it was a veiled insult. I don't know. I am kind of in a combative mood today. You know what it is I just haven't been, I think I've been alone. This is gonna sound stupid, but I actually do think that this could be a thing that's going on. Okay, is I'm between jobs right now. My wife has been working, so there's been many of these days where she's been working late or whatever. She doesn't have the energy, right? So the amount of, let's say hanky panky going on right now isn't very high because she doesn't have the energy. Okay, but I have the energy, and it's been long enough. I'm starting to get that spike in testosterone coming in, right? So I'm probably more combative today than normal because of excess testosterone. And then yesterday I ate way too much, so my body is probably producing a lot of extra things that it doesn't need, making me overly aggressive. It's been over 100 years for safe fortunes to. I mean, that's not really accurate. Yeah, I'm argumentative because I'm insulted. I think it might be easy. I mean, I wouldn't present it that way, but yes, I think that might be. I may be judgmental, maybe need to fix myself. Okay, no, whatever. I'm just noticing that I seem way more aggressive today than normal, right? Am I wrong? So I'm trying to come up with reasons because there's something off with me because I didn't sleep very well last night. I couldn't sleep. When I did sleep, I was having those. You ever have those dreams where like you can't wake up or whatever, or like you think that you need to wake up and you can't do it. You're trying to move but you can't move. I was having dreams like that. So, and like one of the things that happened was we made a casserole. I was hungry, so I ate a good amount of that casserole, right? And then I tried to get the kids to eat it, but my toddlers, they just will not eat anything that they don't recognize. The other day, because Ethan, he's been talking and his favorite word is chocolate. He goes, chocolate, over and over and over and over and over again. So we're trying to get it out of the fridge, and I don't want to like mix it up with this Hershey syrup and all this sort of crap, right? So there's a chocolate milk jug in the fridge that we need to drink. I don't want that to go bad. So I pull that out and pour that for him. He was so upset. No, that's not the right way to, that's not really chocolate. So what I did was I pulled out the other milk jug and pretended to make a glass like the way that he wants, but it was actually the glass that I already poured, and then he drank it. He was just fine. Smart children, no. I don't think so, but Ethan, too early to tell. Asher is autistic max. You're fine, Tilt. This is like, it's a part of what you have to do, right? So going back to this thing, like a trader that is not interested in the politics, it typically doesn't become a very successful trader. And this is something that I've heard frequently from like the guys in the professional world. Like they want to hire people that have an opinion on the market. Somebody that's not interested in the market like doesn't survive. So, it's kind of like maybe only tangentially related to what we do in trading, but it's by discussing these issues and talking about them is kind of how you learn this information, so that when something political happens that is relevant to the markets, you have all of the context necessary to make a good trade out of it, right? These retail traders have got in their heads that day trading is really just all about reading a 1 or 5 minute chart and seeing chart patterns in it. If you want to try that, be my guest, but I've been doing a lot of backtesting. It seems to me that the market is extremely efficient and that you're not going to have a whole lot of success if you're just looking at a 1 or a 5 minute chart and trying to trade off of that. But you have to know what's actually going on in the world. Were you trading when Donald Trump, you mean like during COVID? Yes, that was a mess. I don't know if it's really fair to call it Trump closed the economy. Like everybody closed, every country did that. So it was kind of a collective decision because that's what the experts told us to do. Now, I wonder, has anybody done a post analysis, basically like, if we hadn't have shut down the economy for 2 weeks, what would have happened? I don't think I've ever seen that. Because it does still seem to me that you would have had some really big issues. Like, I think that hospitals would have been overwhelmed. What, like, the net effect of that is on things is I'm not so sure. Yeah, you can't close the economy on a federal level. Every state did it individually, even in Florida. Yeah. Well, that's true as well. I mean, but I think it still was kind of a decision. Like, the Trump administration basically asked them to do it. Yeah, the thing that I remember so vividly from all of that I don't really see people talk about, but was like, Trump was so reluctant to do it in the beginning. And then after the 2 weeks was over, he was all in on, we got to get the economy going back as fast as we can. Donald Trump was obsessed with this idea that the strength of the economy was going to impact his election chances. And what really actually happened was that by the time the election came along, people cared more about how seriously are you taking the pandemic than like what the absolute state of the economy was. Yeah, it was encouraged on the federal level. That's fair, but not ordered. That's true. Yeah. Now, Rudd, when he says, look at Sweden, it seems to me that if you give people the right information, that they're pretty good at like optimizing things for and figuring out what is appropriate for them. And that like an from on high, shut everything down sort of idea is not very bright. Yeah, well, because it just didn't work as well as the way that, because it's not like they didn't shut things down in Sweden. Like, they shut things down in Sweden. It was just like nobody in the government said to do that. Companies did it themselves. And that, from the data that I've seen, that seemed to work better. BS says likely no serious fallout from ignoring. Okay, that's a good theory, but what would you offer as supporting evidence for the idea that not doing, just ignoring it would have been, there wouldn't have been any serious repercussions from just ignoring it? There was definitely a period there where there was a lot of infections. There was a lot of people that died, and hospitals were taking on a lot of people. And if it had not been spread out because of keeping things shut down, I really don't think that the medical system would have been able to handle it very well. I don't know. I suppose that I do believe that if we had ignored it, the economic repercussions from it would have been relatively mild. That might be true. None of the measures taken. Well, I don't know if I agree with that. They flattened the curve. You know what? This is something going back again that kind of pisses me off. Like, have you ever been to these subreddits on Reddit that are like zero spread, or I forget the name of it, but there's like a zero COVID. I think it's called zero COVID. There's a subreddit where all of the people in the subreddit are still around the absolutely everything should be done humanly possible to prevent the spread of this virus, and we should shut down everything that we can, and yada yada yada, right? Is just it's so frustrating that what we said was we need to flatten the curve. And then this group of people said, no, it should be zero COVID. And like so much of the country went along with that zero COVID thing. Like there was places in California that were just shut down for months and months and months and months. That's absolutely nuts. When the whole thing was, I don't think that everybody understood. The whole thing was like, you're probably all going to catch it. It's just we don't want you to all catch it at the same time. Like, people didn't understand that, I guess. Yeah, people were afraid and it was a religion. Yeah, and some people are still captivated by that religion for sure. You know what? Actually, it reminds me of autism. So I made a couple of little like side comments at the beginning of the stream. You guys probably didn't know what I was talking about, but there was this thread on Reddit that was like, what's with Elon Musk? Like, he'll say these things, but then he'll like come out with like all of these crazy insults and everything. Like, what's with that? And they said, well, he's autistic. And I got downvoted really heavily on Reddit for that. I think because everybody on Reddit wants to have an excuse for why Elon Musk is evil, or that we should hate Elon Musk. And if we say, well, actually it's his autism and that must be like some sort of an out for him. But I'm telling you, the best explanation, the most likely reason for what we view as odd behavior from Elon Musk is that he's autistic. He's said publicly that he's autistic. He displays all of the behaviors that I would say autistic people have. He is a high functioning level 1, what you would previously call Asperger's. And one of the hallmarks for autism that you'll see is that they have difficulty controlling their emotions. Some people will confuse this difficulty controlling emotions with like narcissism or sociopathy or something like that. But it's really, when you look at it, it's really that's an autistic person that's starting to become overwhelmed by everything, and they just lash out because they're not very good at controlling their emotions. And that's why it goes from like this really clean argument-based argument, and then all of a sudden F you, right? Like it's a super crazy bipolar sort of a thing. It's autism. And I don't think that the society really understands the impact that autism plays in our society. We want to think of it as this is just this kind of niche psychological issue that, you know, don't really need to worry about because I don't have that, my kids don't have that, doesn't really affect me. But the reality is that a pretty sizable portion of the population has it. There's another pretty sizable portion of the population that, while they don't have it to be diagnosed with it, as in that it affects their life negatively, that they do have certain characteristics and personality traits that you would associate with autism. And this affects online discourse in a way that I don't think that a lot of people realize, because autistic people become extremely likely to participate in online discussions. And so there are many discussions, I think, going on out there that are like adversely impacted by autism, like too many autistic people in there. And I think that COVID was one of those issues. Like those people that are zero COVID and are still absolutely terrified out of their minds about catching COVID and thinking that everything should still be shut down because we haven't defeated the virus and all of these sorts of things, I would bet you, if you went and you did a study, you would find that that group of people has a substantially higher incidence of autism in it. Because that's the whole thing where it's like they have difficulty adjusting and changing to things, and they have you know, they might be pretty good at logic, but they're not very good with kind of more logic that requires a bit of intuition, right? So is it a holiday? Basically it's a holiday, yes. I didn't notice any instruments pausing though. Jacob asks, which treasury products do you mainly trade? Mostly the 10-year. So I've been putting over the last, year and a half, 2 years now, I've been putting all of my trades in these micro treasuries. Like, I trade super, super small. Probably, you know, my results kind of suggest that I should size up, but, you know, I don't really feel like I need to. But I like to keep it small. But there's some real advantages over here in the main treasury because of the liquidity and everything. You can kind of take multiple contracts and sort it out and stuff. Oh, your ES DOM is not moving. Oh, maybe because the futures closed it now. Because the stock market itself is not open today. And I don't know if the CME has early open, but I don't know. I don't know the answer, and I don't care because I don't plan on taking any trades today because it is basically a bank holiday. Sorry, guys. You know what it is, guys. Listen, here's what happens. Okay, when you first start trading, for the first couple of years, you go and you take a trade and you make money from it, and it's like the most amazing thing in the world. Like catching a big winner is a unique feeling, isn't it? There's nothing quite like that. And you will get addicted to that chemical run, right? Like, there's this rush of dopamine that you get from those successful wins, and your brain wants more and more and more of it. And this is where you get these guys that, like, they just started trading and they just want to consume as much about trading as they possibly can, right? Because they're getting the chemical high from it. So the place where I deal with this the most often is on our Discord, that the really novice traders always seem to pop in on Saturdays when nobody's around. Like the older traders, you've been around and you don't get that high from the chemicals anymore, and the all of this stress and the bad feelings from when you lose, like in your mind, is just kind of unavoidable. That your system will start to see that more than the times that you really won, right? And when it gets to that point, it's like you only want to do trading when you're trading, right? And if it's Saturday, I'm doing as far away from trading as I can, you know? So that's where I'm at. It's like, hey, we got a free day here. A holiday in the middle of the week, a holiday not holiday. Yeah, like the CME is open. You know, there are numbers moving, but I'm not going to take a trade from it. I have zero interest in taking a trade on this today. The more you learn about different things in trading, the more you're stuck in the ditch of losing. Well, I wouldn't say that, but just that as time goes on, your chemical relationship with trading shifts, and generally speaking will become like kind of a negative relationship. That like when you win, it's kind of meh, and when you lose, it really gets you down. and that when you're on a losing streak, it's gets really hard to pull yourself out. But you just have to. That's where discipline, having a strict enough plan that you can follow through on it, even when you're not in the best emotional state, right? What is the best platform? Well, I suppose it kind of depends on what you're doing. Because I'm focused mostly on the treasuries, there's a lot of opportunity to read the order flow. I think there's a lot of opportunity to read order flow in pretty much every instrument. I think that there is a lot of untapped edge out there, especially for stocks at order flow. But the treasuries, because they are so thick, it's kind of like a more important part of the treasuries. So that's why I trade with Jigsaw, because Jigsaw really has the best order flow tools and the best DOM. It's not the only acceptable answer, but I think it's the best one. And by and large, though, I would say that you can probably do just fine with just about every platform. The only platform that I really don't like is MetaTrader. So... Yeah, Alex says, why is the market not moving? Because it is a national day of mourning for Jimmy Carter. So it does look like that basically the CME allowed the pre-market trading for it, but now that the stock market is open, it's frozen. Not the case with the treasuries. Probably it's an early end session for the treasuries, though. So, settle in. MetaTrader has the cleanest chart. Okay. So, like, my biggest thing about MetaTrader is that I just feel like it's a scummy platform. Like, the brokers, like, especially when it was Forex was still a thing, and you know, like there was some really shady Forex brokers out there, and what would they use? MetaTrader. And then on top of that, they have like this robot store inside of it where people can sell their algorithms in there. I mean, that's just like an outright scam, right? Like, it just, nobody's gonna sell you a robot that really works. I could see like I have my indicators, and in the most latest version of the indicators, I have a couple of strategies in there just so you can kind of like see how it works. But I'm not like selling you a strategy that's like, this is a good strategy, you can spend a ton of money and you're gonna make money. No. But MetaTrader has that built into the platform, this thing for you to go and look at those and buy them. Ugh. No. And then whenever I've seen like really big problems, it's always MetaTrader. So yeah, I'm not a fan of MetaTrader at all. At all. That's like the only platform that for futures trading that I would actively avoid. It is not good for futures trading. That just brings me back to, I would like to make my own platform. But oh well. Yeah, it's made for Forex. That's true as well. It really was made for Forex, and they kind of said, hey, well, I think that it will work for futures, and they kind of did that, but it doesn't really have all of the stuff that... Granted, it's been a really long time since I've even touched it, so I don't really remember a whole lot about all of the little nitty-gritty things that I didn't like about it. I see YouTubers selling their proprietary indicators, and I can guarantee MetaTrader has the indicator in their free database. Really? Well, maybe. I mean, most indicators out there that are like being sold are just maybe a more advanced variation of an existing indicator. The variations being more like customization on how they look and things like that, right? This is why I really feel like I have a lot of room to talk about my indicators being more advanced, because we're doing stuff with order flow where I have to like go and look at every order that comes through and make decisions based on that. And it's a completely different game. It's not just taking the price series and running some calculation on it. It ends up being substantially more involved. And then adding the caching on top of that is like a really major feature. So I really think that I have the most sophisticated set of indicators. I wouldn't necessarily say the largest, but a very sophisticated set of indicators. I sell at speculatorseth.com, and I sell it for dirt cheap relative to like what I see most other people doing, selling them for. Platforms won't make you a better trade. Well, there can be things with your platform that hold you back, but I would say that by and large, most of the platforms avoid those problems. I gotta say though, like a lot of one of the things is that like a lot of my indicators are things that there's just like it should be included in the platform. Like you might find an indicator for it on, like if I'm doing TradingView and they have a free library too, right? You might find it like that, but you know, like spreads, like being able to chart a spread. Why is that not built into the platform? I'm really kind of a little bit shocked that it's like we're trading futures and the platform didn't think about that as like, oh, you know, this would be like a relatively important feature that I think we should add in there. Silverback says NinjaTrader froze on my end. Well, if you're looking only at the ES, then you will see it frozen, yes, because it's a national day of mourning. So the stock market itself is not open. So it looks like what happened was they you know, ran things for the pre-market, and then once it would be the normal market time, they just shut the futures down. But if you pull up like the treasuries, you can still see a little bit of activity. There we go, yeah. Then I also have indicators like, you know, this, which kind of has a really complicated model to say, hey, like, let's just assume that there's this market maker out there and he's only market making long. And how would he do that? And what sort of decisions would he make? And then based on that, we calculate rather where his average position would be. And that's this line. That's this blue line here that you see, right? And they will come to that line and bounce off of that line so frequently it's scary. This was very difficult to code. The algorithm seems like relatively straightforward as to what it's doing, but programming it up and in a way that's efficient ended up requiring a number of tricks, let's say. So it was not easy to program, and it's something like, I think it's almost 500 lines of code. So that one's a pretty advanced indicator. I should just take that one off and sell that for $300 because that's what, you know, my competitors would do. For me, both a Ninja Trader and yeah. If you're just watching ES, guys, you're not going to be getting data because the market is not the New York Stock Exchange is not open today. If you're watching other markets like the treasury markets, the CME is still running those right now. But if you're watching equity indexes, they will look frozen. You know what? So I should come in and change the title here. I love that so many people are coming in and asking the question, but oh yes, it's time for me to take children to school. So I will be, I gotta leave here for about 5 minutes and then I'll be right back. And we'll have another hour and I don't know, we can keep, you guys have been leaving enough discussion. We keep doing that because otherwise we could like do programming stuff. All right, but I'll be back. All right, we're back. It took a little bit longer than I thought because I had to wake up the toddlers to do it. So, yeah. Set that. So, yeah, let's talk about indicators, I guess, because you guys were talking about indicators here. So here's the thing. Market is incredibly statistically efficient. This is you got to remember that this is all a competition. So the more people that are using a thing, like a few people using a thing kind of helps, but there's kind of this threshold at which they've taken all of the edge out of it and it becomes a negative edge. So if you think about it, you have the market and it's going around and doing all this stuff. Oh, sorry, we have to have a different color. You know, it's going around and it's doing all of this stuff. Okay. You can come in and you could say, hey, I know that at some future point in the future that the price is going to be here. Like I have a piece of information that tells me exactly the price that it's going to be at that time. Okay. If that is the case, how do I maximize the amount of money that I make off of it? Okay. Well, it turns out that there are ways to calculate these things. And the first person to really kind of think about this thing was, oh my gosh, like I had the name in my mind and like I was about to say it and then it like escaped me. What the heck? Oh my gosh. Albert Kyle in 1985 made a study about like informed traders, that basically how would he trade, right? And there's an optimal number of contracts. There's an optimal number of contracts that you can trade. If you trade more than that, so as you trade it, it will kind of move up to here and then it will be at that price at that time. And then you can sell your contracts at a profit at that price that you selected, right? Okay. If you trade more contracts than that, you do this, then it's going to come back down on you and you're going to lose money on some of those contracts. So it's not the optimal thing, right? And so basically what happens is there's like a set amount of profit that can be taken from any one particular alpha. There's like a set amount. And if there's too many people using that edge, it becomes a negative edge. Okay. So it's competitive. It is. And let's assume that this is something that is created by like the very structure of the market. So it's always going to be there, right? Then your chances of profiting from that particular alpha is entirely dependent on how early you get in, right? If we're talking about a bunch of retail traders trading this particular thing, right? So the more people that know about that particular alpha, like the more people you're going to be competing with. Okay. And so the net result of that is that anything that is popular, widely known, widely available is not going to be very effective. It's just not going to be competitive because it's things that people already know. This edge that we see right here, that might always be there. If that is a structural, it's always going to be there. But the question is, will I be competitive at taking advantage of it? And if everybody knows about it, then I'm probably not going to be able to take advantage of it. I probably still need to know about it so that I don't try going short here. Okay. but it's not going to provide me an edge. So the less widely known a thing is, the more likely it is that you're going to be able to pull an edge from it. There's still going to be very, very difficult, but the more people that know about it, the less likely it is to work. Okay. So based on your argument, VWAP probably the worst indicator being used today. Well, so VWAP is a really great example, actually. So in the 70s, VWAP and TWAP execution became popular methods by which to transact really large orders. That if I had to buy or sell a huge ton of something, you would come in and you would use VWAP, which is basically like if I'm buying and the price is below the VWAP, then I can buy more aggressively because I'm getting better than average execution on it when you consider all orders that have been transacted in that market. And that's where VWAP originated from, right? What started to happen was everybody picked up on that, and the floor traders would see, oh, okay, there's this guy and he's buying it below VWAP. And they would take advantage of that, either by like continuing to push it against them when they knew that he was wrong, or by, you know, kind of pushing it up and not letting it get to where he would be able to buy stuff, and then he'd get at the end of the day and have to buy a ton. And so the floor traders were taking advantage of these guys, and there was a time where the institutional traders were complaining about it. Essentially, it's like, it's so hard to make money because these locals just squeeze me every time. And in 2000, these two guys, Almgren and Chris, they came along and they made a study about executing large portfolio transactions. And what they found was that if you just completely ignore the VWAP and you base your execution almost entirely on the impact that you have on the book, the impact that you have on the depth of market, the limit orders that are already existing out there, to kind of minimize the amount of strain that you put on those market makers. You kind of want to push the market makers just to the point where they're starting to freak out, and then you back off. And you do that over and over again in waves. And they found that your execution was better if you just focused on the liquidity and didn't use the VWAP. So VWAP is still a thing because I think it's a simple algorithm. And for some situations, it's good enough. You add a couple of little things on top of that you know, kind of help. But in many instances, it's kind of good enough. But yeah, there's not really actually explicit edge in VWAP. Like these people are just trying to buy a ton of something, and they are largely price insensitive. And the idea that like price is going to bounce off the VWAP, or that you should do something when it's above or below the VWAP, doesn't provide an edge for you as a retail trader. Totally. Okay. So with that in mind, so what are some of the things that we could potentially use that are maybe not completely mined out, right? Well, the first thing is that there are like relatively large inefficiencies in the markets that institutions are more interested in and work at scale. But there could potentially be small ones that are too small for the large players to really mess with. So that's why, you know, we think that there could be edges still available to retail traders. And then the question is going to be, where are the places that the retail traders aren't looking that those edges could potentially still exist, right? And I think one of the arguments that I've been trying to make for you guys is that not a lot of retail traders are using Orderflow. Like, there's some pretty good Orderflow tools. I think that the indicators that I've added really expand upon that and kind of show you some things that are really, really useful. But by and large, most retail traders aren't doing Orderflow. And they certainly aren't doing Orderflow in a scientific manner, right? Like, there's a lot of retail traders that will have cumulative delta up, that will have a depth of market, but basically zero that are actually like saving and recording their data and then doing historical backtests with that data to figure out how the market actually behaves. So that's where you might be able to develop an edge. So I think the thing that the guy was saying is generally correct, that you're probably not going to find very much edge in a free indicator. That doesn't necessarily mean that you're going to find edge in a paid indicator, but if it's a sophisticated enough thing that not very many people know about, like maybe you can. And especially if it's, like my tools, this is why my tools, I'm not giving you a strategy with it, right? I'm giving you the tools, I'm giving you everything that you need to be able to find your own potential edge. Because if it was a strategy, then it would be like the more popular that the indicator got, the less effective it would be, right? So I can reduce the order flow to a simple candle chart, and I don't think that would be a very effective. So I think that the biggest thing with the order flow is that you have to know, or the biggest statistical aberration that you're going to see in the order flow is autocorrelation of order flow sign. So whether the market orders are buy or sell, there's like a really strong autocorrelation in that. And that just, well, it's not just price action. Because what if the instrument is moving down, but the order flow shows that there's still net buyers, right? Price action, people aren't going to see that. You're not going to see that just on your regular candlestick chart. It's just kind of like another one of those examples of where like traditional technical analysis, it's like I think that modern quantitative trading does owe a little bit of gratitude to technical analysis. But at the end of the day, technical analysis is just not sophisticated enough to really answer the important questions. Because technical analysis was basically all built to try and analyze patterns in price. And the net conclusion that we got off of technical analysis was the market is very statistically efficient, right? And so it's not until you get into these other things like, okay, instead of worrying so much about when I enter and exit the market, instead I worry about which assets I own more of, right? When I have a way of detecting which assets are trending, and I want to own all of the assets that are trending, or I want to overweight those assets, right? And then those are momentum strategies. Asher, why are you putting your hand on my face? No. So take time and sells, for example. Traders say they watch it to see the orders. Well, aren't those orders reflected in candles? You see a bunch of sales orders, you would see a big red candle. Not necessarily. Because, so for instance, there can be a situation where, like if we just were to use cumulative delta, because I think that's the simplest way to represent it, okay, you could have a big down candle, which I will represent by kind of filling it in here. Maybe not. I will represent it with red. We could have a big red candle here. And then when you look at cumulative delta, it's not hardly moving at all. That happens all the time. You could have a situation where it's a teeny tiny little up candle actually, but there was like substantial amount of selling in that period as well. Right? And there are divergences between price and order flow sign all the time. And kind of the thing that you're going to find is that depending on the instrument and, because there's things that you have to factor like correlations, the yield curve, that sort of stuff. Okay. But all things being equal, the order flow sign tends to be a more reliable indicator of where things are going than prices. if you're seeing on this chart, if the chart looks like this, where price is kind of going sideways, but cumulative delta is consistently rising, as long as it's not the S&P 500, that is a really strong buy signal to me. There is a large meta order that is buying, and it's just that there's some correlated instrument or something like that holding it back. But what often happens in that one is it kind of catches up. And especially if I know why it's trading, yeah. If I know why I'm seeing that divergence, I will take that trade every time. See, the issue that you really get with price is that the market makers adjust their bids and offers based on the conditions that they have in the market, right? Like, so if there's a lot of activity and a lot of volatility, I'm going to hold my bids and offers a little bit further away than I normally would. I will increase the spread between my best bid and my best offers to account for that additional volatility, right? I will look at correlated assets and adjust my bid and ask based on those correlated assets, right? Well, a key component of these kinds of market making algorithms is something that these firms have found helps amp up their profits is by just injecting a little bit of liquidity. Just saying, well, okay, it suggests that my best bid, best offer should be here, but I'm also just going to like add a random tick or take away a random tick or something. Like they inject randomness into it. And this is why the chart is so wild. But they make more money by injecting that randomness into it. And when you go and you look at the price chart, okay, because those limit orders are stacking and pulling randomly, a lot of what you're seeing on price is actually just a result of that randomness injected by the liquidity providers. So the way that we get around that is we analyze the market orders exclusively, and that can help us cancel out some of that noise, right? It's just like the end result is that that the market is very statistically efficient on a price basis. But when you start to get into a collection of assets or two assets that have a relationship with each other, or you're looking at the order flow, or you're looking at the volatility of the market as a whole, on all of those things, there are very, very strong statistical aberrations that do not match what a random walk would be. And so those things on their own might not necessarily be enough to make you a profitable trader, but they are some of the most useful technical pieces of information that we have available to us. And when it comes to order flow in particular, there's so much information because there are limit orders at every price. So there's actually a lot to analyze here. And they've done studies recently where they just say, okay, every time that there's a major change in the depth of market, let's like make that into a token and then pass that into an LLM and see if the LLM can predict what the next sequence of events is going to be. And they find that on short time frames that the LLM can actually make extremely predictive calls. And so that's basically you're using an LLM to trade the DOM, but in a way that's like backtestable and like empirical in it. Right? Is there more traders trading cumulative delta divergences than... Well, yeah, you know, you don't really want to trade a divergence. Yeah, so like, especially in the S&P 500, like the S&P 500 is going up and cumulative delta is going down. Don't trade that. There's no edge in that. If in the treasuries, this is flat and cumulative delta is going up, and I'm seeing that across the curve, and more importantly, I think I know why this is happening. Like, I think that we're being held back because of the dollar, but I think that people are buying today because of X. I'll buy that. That's a really good trade. But I think the thing that I'm looking for more than anything is that really consistent, right? That the market orders are persistently in balance in favor of one direction or the other. That's a really, really powerful. That was one of the most powerful statistical, technical kind of indications that we get. And you will not see that on a price chart. You will not see that. If all we ever had was 1 minute data, we would never have found all of these things. Especially not like getting into all these things like that the impact of a large order follows a square root law and all that sort of stuff. A candle is a true reflection of the buyers and sellers in a given time. That's a good theory, but can you prove that? Because what I'm telling you is actually it's not. Right, because there's basically 6 different actions that you can take. You can buy with the market order, you can sell with the market order, you can buy with a limit order, you can sell with a limit order, and you can cancel your limit order or cancel your limit sell order, right? So based on those 6 things, you can kind of adjust things to kind of make price do weird things that don't really accurately reflect what you're ultimately doing, which is like buying a large tranche of something. Or, your usual market making activity. By the way, treasuries sitting on my line at the moment. It's probably likely to bounce a little bit, but it's a quiet market. I would not trade it. Okay, is Ethan okay here? Hold on. Canceled orders aren't in a candle. They are meaningless. They are not meaningless. So I can actually show that. Except for that I don't have it up, so I wouldn't be able to show you like the historical data of it. No, every action has some impact on the market, whether you're adding an order or canceling an order, and like the impact that it has, it's kind of a chaotic thing. So the impact that any one particular order has is kind of a little bit difficult to sort out, like in one individual one. You can say that like the impact of a market order is on average this, but like that specific one, you don't necessarily know. And the weird thing is, again, it follows the square root law, right? So that what that means is that 1% of the volume can be responsible for 10% of the volatility. In other words, those small orders can actually have kind of like an outsized impact on things. But every order has an impact, and I don't have it set up like this to do this. So my level 2 changes, that's this top one right here. I just have that right now set up to be all level 2 changes overall, right? But if you change it and filter it to only orders that are canceling, and compare the buy orders or the buy orders canceling compared to the sell orders canceling, you will find that that correlates to whether we tick up or down more than almost anything else. So, and the reason for that is because some correlated asset ticks up or down, the market makers will cancel their orders because like the price has moved essentially, and then it will move in that direction that they canceled those orders in. And so it's not really a predictive thing, it's a coincident thing, right? But that is more heavily correlated to whether we're ticking up or down than almost anything. That one is one worth pointing out because if you're doing backtesting and your backtesting kind of is affected by that, then it's going to overfit on that. I think what you're saying is, for example, the price is increasing and as it's going up, sell orders cancel. Would that indicate a stronger bullish? Exactly. Well, more broadly, so another example though could be you have a move up and you're not seeing a whole lot of market volume for it. Like earlier, you were seeing a lot of market volume, and now all of a sudden, for some reason, they're not really interested in trading it, but it is moving. What's with that? Why is it moving more on less activity? Well, that's probably a good indication that it's actually a correlated instrument that's moving. That like there's a move happening in the dollar or the Japanese yen or what have you, and that's why the market is moving, right? And so you're going to see that in a market that moves on orders canceling and not really on market orders. Okay, don't cry. You're on camera. Say hi. Right here. Say hi. That didn't sound And I think like more largely, there's just this thing that's like, okay, if all you have is price, if all you have is a 1 minute chart, a 1 minute time price data series, there's like no edge in it that I know of. There's just like, that's what all retail traders are trying to do. They have all of these ideas about how you're supposed to trade that, like support and resistance, chart patterns, doji, candle, all of these sorts of things. And they've all been tested exhaustively. And I've never found a evidence that there's any alpha in that whatsoever. There's just absolutely no, it is pretty much indistinguishable from a random walk, right? Aside from volatility. I guess volatility is something that you can kind of sort out just from the price, okay? But that doesn't really give you anything about direction, okay? Whereas when you're looking at the order flow data, there are countless studies about statistical stylized behaviors that the order flow exhibits. You can't do this same kind of thing with price, but you can on order flow. So the idea that like everything is reflected in price is just it just doesn't match up with what we know about the market, what we know to be proven. Because what we know is, if you have a 1 minute chart, there's not really a whole lot of use in that on its own. It's not to say that like the time price series is like useless. It's really useful for me to go back and look at a chart and say, okay, I know this event happened here. I think that this trend was this thing, right? It helps me organize my thoughts and everything. Ish says, I remember the date. Wow, you're old school, man. Well, is 4 years old now old school? Volume histogram is also another interesting one because people got all of these ideas about the volume profile that just ended up being not correct, right? Figuring out how it's reflecting on, okay, I don't know what you mean by that. What do you think about, I've never heard of Zussi, but ICT is basically a scam. I don't know any other way. I shouldn't use the word scam, but there's basically, I think that he's misrepresented his results. I think he says a lot of things that are just demonstrably false. This whole idea that like the market runs in an algorithm that he wrote and all of these is just absolute nonsense. And you can go and you can backtest some of his strategies and there's no efficacy in them. There did appear to be a period where, because of the again, like a group of people trading on a signal, it can kind of work until it gets too big. Gets too big and then it becomes a negative edge, and I have some evidence. So like the bigger thing here that I want you guys to think about, because like what I'm, especially from Utah, no offense, but I'm just saying what I'm seeing is you have ideas about how the market actually is, but there's no empirical evidence backing up any of those ideas. These are all ideas that are kind of like philosophically based, and you are making from your own deduction. Looking at that, I know this about markets and this, so that must mean this, right? But when you do that, can you back up those ideas with empirical evidence? And the thing about trading that's kind of weird is that you want to have your foundation based on empirical evidence, but there is a certain point at which it is inevitable that you have to venture beyond what the empirical evidence can show you, right? Like I can say, okay, there's empirical evidence. The kid just gave me a wrench for some reason. What the heck was that? I can say that there's this, order flow exhibits this behavior and this behavior and this behavior. So those are things that are proven that have empirical evidence that back them up. But can I take all of those things, combine them together into my own intuition, along with other informational inefficiencies, things that I might know that other people don't know? Can I combine all of those things together into a profitable strategy? That's not empirically proven. How would you empirically prove that? It's not really duplicatable because it's based on my own intuition, right? You can't duplicate my intuition anywhere else. Therefore, it can never be empirical. It can only be anecdotal, right? So there's always this point at which you kind of have to make this jump, right? But what I see in retail traders is that they build this whole philosophy about what the market is and how it works without any data to back it up whatsoever. And the most common way that exhibits is this idea that the price is reflective of everything that there is to know. And that I think that that's kind of a variation on the idea that the market is perfectly efficient. But the price, just the reality of it is that the price doesn't tell you a whole lot. It's only this one little tiny piece of data. And it's completely dwarfed by the amount of order flow data that you have. Like, if I'm going to save all of the data myself, okay, saving a year's worth of 1 minute time price information? Simple. What's wrong, Ethan? He was whining so that I would see him, that he's standing on top of my subwoofer. It doesn't take a whole lot of space, and it's not very complicated to store 1 minute time price data, right? But storing that information for a bunch of different instruments and all of the order flow information and all of the like informational information that you might be getting from like reading Twitter and your news squawk and seeing, you know, all of these other things, like now you're getting into something that I'm not sure that there's any way to do yet, you know? Right? And retail trading is all focused on this one teeny tiny little piece of data that all of the information that we have says that there's no edge in it. We gotta fix it now. There we go. There you go. I fixed it. Okay, so that's a great idea. Okay, so there's no edge in understanding how price, well, your foot is okay though. I would kiss it better. You want me to kiss it better? So like this thing that, what? Oh my gosh. I would backtest that if I didn't have kids with me right now. Like can I copy that? Yeah. Maybe we can do it tomorrow. High volume and a large green bar, followed by an even higher spike on a what do you mean by a squat doji bar? I mean, I know what a doji is, but what is a squat? Jeez. Okay. Right. Okay. So we could very easily go into the market and we could say, okay, there's a large green bar and it's a high volume. Like we can say relative to the volatility of the market, this bar is large, right? And that relative to the volume, that the volume on this is large. And we can identify that bar. And then we can identify that that the next bar is even higher, but that it is a doji bar, right? And then we can say when that situation happens, buy it. But I can almost guarantee you what's going to happen is if we include enough data, you're going to find that there's no edge to it. That it, on a risk-adjusted basis, that it's random. It's probably. Well, we're not backtesting anything man-meat, but that was just, I'm going to save that. And maybe we can backtest it tomorrow. I think these kids are going to go to bed early today. I'm thinking, you know, we're talking about like, you know what? I'm still stuck on that Uzi called me an incel. It's like, no, I mean, you're not an incel if it's just been a few days. Okay. But it does, at least for me, it does affect me. It does affect my mood. The kids are going to go to sleep early tonight. So I'm going to have to plan things to figure out how I can... You're a nuance. What's wrong? Oh, you want... Well, Ethan, you didn't grab the laptop. I know. It's sad. And he's going to watch other YouTube videos in the background, and you're going to hear him, and then we'll get a strike. But I should probably just shut the stream down. What is well, let me go back here. Got a project to create pure price cleared from correlated market to gauge fair price. Okay. Like I'm seeing like lots of claims now, but I'm like, do you have the empirical evidence for that? Because now you're just getting into things that are like, we can generate empirical evidence for it. But you have to explain to me before I go, what is a squat bar? Because you know, in my circles, a squat bar is very different, right? It's a, you know, it's a bar that you do squats with. Short, tight range, narrow is a squat bar. Okay, so how is a squat bar different from a doji? Well, we only care about, we can define all of those other things, right? But you have to explain what a squat bar is. Like, what are the technical qualifications? Why is, so they have this on this thing here, this is circled. Why is that a squat bar and that is not? You're okay. I know it is kind of sad when people make claims without empirical evidence, but we can just backtest it. It's fine. Opinion on quantitative. Well, there are people that make money from quantitative strategies in the market. Yeah, it's just that's a really, really broad category of strategies, right? Yeah, I think he's talking about bars that eat up a pile of volume without moving. So that would mean it's a bar with small range but high volume. So I think what he's saying is, I think what it should look like would be, you have a large up candle, and then the next candle, it is higher, but it's tight range. If you're looking for exact, well, but we got to be quantitative about it, right? So if I come in and I say, okay, this is what we're going to define as a squat bar, and then you're going to say, well, but it doesn't catch all squat bars, then we have to find a way that accurately catches all squat bars. Otherwise, so all you're doing is injecting confirmation bias into it, right? Where you're deciding what are squat bars and what are not on how you feel. So we have to be able to express it quantitatively. Now, the difficulty in there is that there is volatility, right? So what is a squat bar one day might not qualify as a squat bar another day. But we have ways of dealing with that, right? We can use, we can generate statistics about the range of bars and the volume of bars to be able to identify bars where, the range and the volume of those bars is unusual. And then we can define the certain threshold that we're going to say is acceptable, or we can do backtesting to help us determine which threshold is the most optimal. Yes, and if the volume is spiked on the squat bar, it's a clean signals. So you're saying that if we're looking at volume, that there's more volume on the second candle? Sure. Okay. I don't think that's going to work. For that to happen, I think that there would be a very high probability of there being some sort of a large iceberg selling in that. So this just kind of comes back to this whole thing that what happens in price isn't really necessarily tell you the whole story. If I know that the reason that all of that volume in there happened was because of all of the all of the, let's say, the short-term traders, short-term market orders clashing into one really big sell iceberg, you don't necessarily know that that's what's happening from the bars. But it's pretty good. That's probably like one of the only situations where that would happen. Could be a situation where it's a bunch of buyers hitting into a bunch of sellers and yada yada. But then there's also there could be a situation where in this second bar there's more buyers than sellers, more market buyers than market sellers, and there could be a situation where there's more market sellers than market buyers. Like it could be that it came up there and then somebody decided to sell it and they ran into a buy side iceberg instead. And which of those two is the iceberg, a buy side or a sell side? You won't know that from just the chart. Does that matter? Well, I don't know. We'd have to collect data on it. So last time I looked up volume spread analysis, it had really more to do with buy the S&P 500 when it comes back to the 200-day moving average. Wasn't really. This is one that's come up many times, and here's the thing that I would say is set down what the rules of the strategy are, and then let's backtest it. I know, because I just don't have time to read about every strategy out there, right? But if you want to talk about something, we're going to have empirical evidence to talk about it with. You just write down the rules of it, right? It's the first time I've heard of this quote-unquote squat bar. Well, it sounds like it is a thing that he's not the only person online using that term. But it sounds like he's essentially saying bar one is a bar with high volume and a high change in price. And then the second bar is a one that has a low change in price, but still high volume. It doesn't matter. The big green bar met little. No, see, you're not listening. My gosh, I always find this conversation so frustrating. You say, what does common sense logic tell you? And I'm saying, your common sense logic is not really very effective at doing this sort of a thing. There's all of these other compounding factors. There's all of these extra biases that come in. I don't care what your logic or your deduction or any of these things suggest should happen. My question is, what actually does happen? And the only way that we can do that is if we define a strict test through which we can collect data that other people can also do the same thing and verify so that it is empirical. So the only question is, what empirical evidence do we have to back up this idea? Honestly, if you had the next bar, a lot of volume but no price movement, I'm going to bet you that most of the time it doesn't move very much after that. Like, probably what's going to happen, I think you're suggesting a trade like that it's going to go up, you're going to get this bar, and then it's going to go even higher a bar later. But I'm going to bet you that if we backtest it, that what's more likely to happen is it just go flat after this and stay there. Yes, you do. You do. You're not bot trading. You don't need to backtest. I think that's naive. Because what you're going to do, your human mind is literally not capable of looking at enough information and data to make the kind of conclusion that you are making. It was really common for people to take that kind of an approach when they either, one, don't know how to create the empirical evidence, right? Or B, they don't like what the empirical evidence says. They still want to believe it, even though the empirical evidence says that there's no, that it's random. You say it's a potential reversal signal. Okay. If you think it's a reversal signal, we'll test it. I'm going to bet you're wrong, actually, though. We'll test it tomorrow, and I bet you. So here's what we'll do, is we'll say, let's just pick a random time and get in the market and stay in the market for 5 minutes at any random time. And when we do that, how much does the market tend to move in favor of us, and how much does the market tend to move against us? Okay. And then we're going to go and test this particular setup. So when this happens, and we get this bar, the beginning of this next bar here, we're going to enter in, right? This is first bar, and then there's a second bar. When this bar closes, we're going to take the reversal. And then we're going to look at how much that goes in our favor and how much that goes against us. And I think that you are going to find that the favorable and adverse excursion on that trade are relatively equal, that there's not really any kind of like percentage win rate, and that there's actually kind of this tendency for the market to get stuck. So why do I think that that's going to happen? So there's this whole thing called a Walrasian auction. So like in a Walrasian auction, it's like, okay, in 5 minutes, you all submit your orders, and then in 5 minutes, we're going to match them all up. So you have a bunch of people, and they want to buy like this, right? And then you have a bunch of other people, and they want to sell like this, right? Okay. And these people right here in the middle are the ones that are going to get filled. Okay. These ones on the outside that do not get filled will just still be there. So what you're going to get is something that looks kind of like this. So here you had this, and then, here's where the people got filled, right? And then over here, you're going to have this. And then here's kind of where the people got filled, right? So this here at this point now is like the next auction. This is what the next auction looks like, right? And so essentially what has happened now is that because all of these people got filled in here in the middle, right? There is less liquidity in the middle, essentially. There's less liquidity to hit into. So if I try to buy a ton of it, like I'm going to move up really easily through here, but then I'm going to quickly come into, there's more orders here, right? So that kind of pushes us down. And if I go this way, you know, it's going to do the same thing. And so what tends to happen is the market just gets stuck in a range. So you will see that like the most common chart pattern that you're going to see when that's happening. And I'm not saying when you see this happen, this is a signal for something, but I am saying a pattern does result from it. But the pattern is the result. It's not the setup. Okay. Is it's going to do this. And then maybe it does that. Right. Maybe it does that. So a large amount of transacting in a very, very small area tends to create a liquidity hole. So that's why I'm going to bet that if you do it with a timed exit 5 minutes, that the volatility may actually be less than you expect it to. It's probably going to be like, so like if we're going to take a distribution, right? So we take a trade, random trade, and we're going to get like this random distribution, right? This is the number of ticks that it goes in, you know, this is the net profit on the trade. Okay. This is the net profit in the trade. And I think that what you will see is with this setup, it's going to be more like this. That most of the time there is, it just stays there, but that there are tails. Okay. You might suggest that that it looks like this. That it has a higher chance of it being a reversal in that situation. But I don't think that the stats are going to prove that out. So what I've done here is I've basically said, here's my theory of what the data is going to look like, right? So we've defined a test, and now we've defined what kind of statistical results we're looking for, or we're trying to prove here, right? Now, all we have to do is go and write the code and see how the market has actually behaved in the past based off of that. I don't know why you would not want to test it, but I don't know. Any info I did provide you, if you have empirical evidence, then let's look at the empirical evidence. Because if you have empirical evidence that proves it true, then I just have to take it all back, right? See, the real issue here, though, is that you don't want to do it empirically, right? You basically explicitly said that you can't prove it empirically. So at the end of the range when this up. Well, so now you're adding another qualification to it, right? But I'm gonna bet you it's 50. I'm gonna bet you it's probably pre 50-50. You want to go watch that, Ethan? Maybe he is gonna give us the opportunity to do it, right? It's a very difficult time. It's not difficult. I guess backtesting every little thing. Oh, no. Don't bring food in here. You know what? I'm wrong. We're not going to program. We'll program it. Tomorrow we'll have a whole 2 hours to do it. I think this is a great test. There'll be a couple of little interesting things that we can do on it. Yeah, come back. I'll give you guys reasons to come back tomorrow. Okay, we'll do it tomorrow. We'll do it live. Okay, stay excellent, team.